So the last category of tactical entries that I'd like to discuss are the pullbacks. Most people like to think in terms of pullbacks because they have a hard time dealing with the volatility of breakouts, and pullbacks, tend to take that away a little bit because you're buying as the stock is consolidating. One of the drawbacks of the pullback, if it's done improperly, you can just be buying a stock that's starting a new trend lower, and it's really hard to nail that exact point to buy as it's coming down. Whereas when you're buying a stock going up, you know the market is already moving in your direction. Why do pullbacks work? Well, in any uptrend, no matter how strong it is, there's always going to be certain points of times where buyers become a little too stretched and sellers are going to be able to overwhelm them to the downside. You can think of, in terms of warfare, you can have a great army and really advance really quickly, but at a certain point you need supply lines to catch up. You need that fuel for your tanks or whatever it would be that will keep propelling the move forward into enemy territory. And so that's really the way you want to look at this. You want to look for a stock that's having a steady advance, and this is really just a consolidation in that upward trend. And there's a number of ways that I'd like to identify that. I want to be really precise with how we do this because, again, it could be tricky, and just buying any pullback can lead you to the wrong thinking in that you're looking to buy stocks coming down. You always want to stay with the same original principles of the strategy, whereas you want to buy a stock that's proving growth and that the market is agreeing with your perspective and institutions are accumulating the stock. So a stock falling is not typically accumulation. There's some selling going on there. Now, it's great because it gives you sometimes a low-risk entry and the stock is pausing, so you have some good upside once the pause is over, but you want to keep that in mind and always use pullbacks in the right context. Before we move on, I'm just going to review once again the moving averages of importance for this style of tactical pattern so that you know which averages I'm pointing out to on the different charts when we're looking at them. So this chart we looked at earlier in the course, so this is just a very quick reminder. Again, I mentioned last time you should probably keep this chart with you as a good reference point. The blue line here is your 200-day moving average. The red line is your 50-day. The light blue line is your 10-week moving average, but on a daily chart. The light pink is your 8 exponential moving average, and the very tight moving average here is your 3-day exponential moving average. So the first pattern we're going to look at here is a failed breakout pullback. And the only reason I know this works is because I was stopped out of so many stocks trying to buy breakouts that I finally realized, like, wait, maybe there's a better way. And I noticed many times, I know the 21-day exponential is typically an important average for a stock. I'll go interchangeably between 20, 21. People use variations. It doesn't really change the outcome of your trading. It's whatever you prefer. And the way I like to use this strategy is many times you'll see a stock has this great shaper pattern. It could be a cup, it could be a double bottom, whatever it is. But when you break the prior highs of this base, there's almost an immediate snapback lower. And it happens within a couple of days. And this is really the real frustration of everybody who buys breakouts. This is what they hate. But you know what? You might as well use that to your advantage. And you'll see, once you take out the highs, if you fail within a couple of days, the best place to buy is on the first test of the 20-day moving average. Now, whereas with almost every other pattern, I just simply say use the low of that bar as your exit point. With pullbacks, again, that's why it's not so clear. You can't really just use the low of a bar because you're buying a range. You're buying an area of where there should be support. So the way I like to approach pullback buys, especially in this case here, is once it gets to the 20-day, I buy it on the 20, but I give myself a simple 5% stop. And that usually gives enough room for the stock to hit the 20, bounce around, but not stop you out. You can see here, we broke the highs once again and immediately came right back down to the 20-day again. So either of these two could have served as a great buy point. And if you didn't enter properly, if you were stopped out and you bought these breakouts and you weren't aware of this kind of a pullback buy entry, you missed out on this 90% advance in only 8 months. So that's why it's really important that you have many tools in your toolbox. And if all you're doing is buying breakouts, well, if you're stopped out, then you miss this move. Because let me tell you, the first time, maybe you'll buy it, maybe you'll try it a second time. Most traders by that third time will be pretty frustrated in buying that stock. So having this alternate way to enter around prior highs is a great tool to have. And you'll see this doesn't happen just to Alexion Pharmaceuticals. This happened to Lululemon as well. And we know Lulu turned into a huge winner because we discussed it earlier. But that same pattern existed here. This was that double bottom base we looked at in 2010. We discussed the earnings gap up. But when we finally took out the left side of that base, we almost immediately snapped back to the 20-day moving average. Now, again, the reason that happens, all the short-term traders buying this breakout are just pushed out of that stock. It's almost amazing to think that these stocks with these huge trends, if you look at from the low price to the high, it's a relatively straight line. And it'd be almost difficult to lose money buying the stock if you start buying it from early September. And the two worst points probably would have been above the prior highs, above this high here, and then again above this high here. So that's really the turbulence zone of prior highs that I mentioned before in breakouts is a real thing. It's really a point that these algorithms, these big traders use to shake out these short-term traders. But using this pullback entry, you can use it to your advantage. So you'll see here, once you broke the highs, you pulled back to your 20-day moving average. Very difficult to use just to stop at the low of the day. So I use that simple 5% stop. Again, here you touched the 20, you went just a little bit lower, but you stayed within 5% in both these examples, and we eventually had a 130% advance in only 6 months. If you stop and think, if you were stopped out of these two breakouts, either the first time or the second time, how frustrating would it be to miss out on 130% advance in 6 months? You need these alternate tools to really help you get in there at the right time and not be stopped out of these major winners. Here is Square, very similar cup base to that Alexion Pharmaceuticals we looked at first in this pattern. Again, it's hard to believe from the lows of this base to the highs that you would have been stopped out anywhere, but once you broke the highs here, you had this almost immediate snapback 2 days later, right to the 20-day moving average. And you could really tell this prior high as a point of resistance. You just barely took out the high of the day and immediately moved the other way. So this is really all the short-term people being pushed out of the stock. And buying on the 20-day was a perfect entry point. I like to, again, use the same stocks to just show how this happens over and over again. And Square took out the high of this cupping formation here in the middle of 2017. And again, you didn't snap back as aggressively, but you finally did take out the low of this bar after a sideways consolidation. And this probably would have shaken out a lot of people who bought the breakout and were frustrated that there was no upside progress. But this pullback to the 20 was that great entryway to have along this uptrend. I mean, to think about it, if you look at this whole move up, this is really one of the only few days you get a real snapback, and it was just to shake out the buyers who bought the prior high. And you have this incredible 80% advance in only 2 months. Here's Square once again, a little bit later on. And again, we have a prior high here. This is the 2020 advance. We break above the prior high, and it seems like the only place the stock actually paused was right here at the prior high. It's unbelievable. You snap back right to that 20-day moving average, and then you had a 230% advance in only 9 months. So as you can see with Square, which has been a major winner, you have 3 really precise, low-risk entries on the 20 after these failed breakouts as a great way to enter into the stock. The next pullback pattern I want to study here is a 10-week pullback. So I really specify, I use the 10-week moving average instead of the 50-day. I tend to really look at these patterns on weekly charts, the shapers like we discussed early on. And maybe William O'Neill always had his weekly charts. I became accustomed to it, but I really like to use a pullback to the 10-week. Even though it's so similar to the 50-day, I prefer the 10-week. If you prefer a 50-day moving average and you like to live on daily charts, that's fine. You're pretty much going to get to the same point, but just keep in mind that's why I use the 10-week moving average. Also, early in the week, like I discussed prior, the 10-week can be a little bit higher than the 50-day, and they usually line up again on that Friday close. So earlier in the week, it allows me to be a little bit more aggressive with the 10-week than the 50-day moving average. So the correct way to buy the 10-week moving average, because you can't just buy every time it touches the 10-week moving average, but the correct way that I use this pullback is once we break out of a shaper pattern, I'll use the first touch of the 10-week line after we've expanded away from the base. So this first test of the 10-week is not correct because you're still within the basing structure, so it's not even broken out yet. Here we had a breakout of this basing structure, but you never had a real expansion phase, and this pullback to the 10-week occurs within the prior basing structure. So you want the pullback to the 10-week to happen above the prior basing structure so that you know you had that expansion and that the breakout really did take hold. So once we have this real strong move higher here on Dexcom, DXCM, we finally had that first snapback to the 10-week moving average. So buyers are clearly in control, and that best place to buy is really on that 10-week touch. Similar to the 20-day pullback, I use a simple 5% stop, and from that pullback, we had 150% advance in only 9 months. So a really powerful entry point that you can buy on the way down, but you really want to use it as the first touch after the stock expands away from a proper shaper pattern. Here's Dexcom again, just to keep with the same stock. We formed another very nice cup with handle here in late 2014. We expand away from the base, and the very first touch, that 10-week moving average, provided a great entry point. We had another 80% advance in only 8 months. Here's Peloton, one of the big winners of the 2020 COVID bull market. We had this wonderful cup with handle here, base that happened during the COVID crash. It was showing a lot of relative strength. Peloton made to new highs way before the market made it to new highs. And after a substantial advance, the very first touch of the 10-week moving average gave you this great entry point. And you had 120% advance in only 2 months after touching that 10-week average. This is a good example of where I like to use the 10-week versus the 50-day. And you can see here it didn't quite get to the 50-day moving average. And I find some of these really strong stocks, for whatever reason, I don't know what it is, tend to touch the 10-week and just get shy of that 50-day moving average. So call it personal preference, but that's why I like to use the 10-week moving average. Here's Southwest Energies, another good example of how you really want to be specific with your buy points. You had your cup and handle here that formed, and we had a move higher, but I think it was probably a result of the market being very weak in this period. The stock didn't just explode higher. We went into another consolidation right above the prior highs. And these two touches of the 10 weeks were incorrect because they were really within the prior basing structure. And so once we had a real expansion phase higher, that first touch of the 10-week moving average was really your entry. And we just rocketed higher, and this was a huge winner back in 2004, Southwestern Energies. So here is Viva Systems, and we're looking back again at that period of time in late 2018. We had all of those great tactical patterns that came in, and if you missed any of those, we had another entry with the 10-week pullback. I mean, again, we had that great kicker pattern, we had a good 3 EMA shakeout, we had that 50-day resistance failure expectation breaker, and once we broke out of this shaper pattern, we had our expansion phase, and our first pullback to the 10-week average gave you a great low-risk entry, and the buy point occurred above the basing structure. And from there, we went pretty much straight up. The last pullback pattern I want to discuss is the gap pullback. So we discussed, breakaway gaps before, buyable gap ups. Sometimes people really have a hard time dealing with them, and so I'm providing a couple of different ways to work around gaps. Sometimes people don't want to buy the gap up. People don't want to buy on the close of the gap up because the volatility is so high. And so an alternate technique that I like to use if those conditions really bother you, and I'll use it to add to my position as well, is once a gap up happens, you want to gap away from a base again. You want minimal progress, so only a couple of days, not 2 or 3 weeks of advancing. And our pullback to the 8 exponential day moving average is where I'm going to buy. So that's what this light pink line is, the 8 exponential moving average. Here because again, you're buying on the way down after a gap. I keep either an initial 5% stop because, look, it could just go right through that average and keep falling. So waiting for the close of the day just entails too much risk. So I'll keep a 5% stop when I initially buy it, and I want it to close above the average that day. So if we hit that average, and we find support and we bounce, great, the position stays on. But if we buy that stock, it hits the average but closes below that average, I'll take my very small loss and I'll step away. Now, this pattern will probably have a higher failure rate because not everything stops at the average, and maybe it's going to a 20-day average, we don't know. But it works often enough that it gives you such a great low-risk entry. And here, it's a really low-risk entry. And if it works, you tend to have immediate upside action because it's just that first little pullback after this expansion phase. So we'll look at example after example, though, because it seems like, the 8 exponential may just be any other average, but it really works very well, and I've used it many times in my trading. Let's move to Amazon.com. We had our breakaway out of this shaper pattern. We gapped up. We had only one more day of additional advance. We pulled back to our 8 exponential moving average. It bounced right off of there and didn't close below, and we advanced right after the gap. Here's another example of Avalar, AVLR. We gapped out of this shaper pattern. We advanced only for 1 day more. We pulled back right to the 8 exponential moving average. We ended up closing higher on the day, and this ended up becoming a big winner from that point on. Here's Meldi, Mercado Libre. We had a very nice cup with handle shaper pattern. This is off of the COVID crash. We gapped higher. We made progress of only a couple of more days, pulled back right to that 8 exponential moving average. Once we had that touch, we turned around, closed strong, and it started its very strong advance. Here we have Monster Beverage. Back in 2014, we gapped out of this nice sideways consolidation. Sometimes buying the gap up is frustrating. You get these pullbacks like this. It was such a substantial gap that we pulled back right to that 8 exponential moving average. We tagged it, and we moved higher from there, and you had a really good low-risk entry. Here is Netflix again in 2010. We discussed this buyable gap up. Actually, I discussed how if you bought the close of the gap and put your initial risk at the opening of that bar, you would have been stopped out. That's why if you don't want to deal with that initial gap up day, although you may miss some runaway moves like I mentioned, waiting for that pullback was that great pullback entry right here on the 8 exponential moving average. And from that point here, it was pretty much a straight rocket ride, much higher. Spotify is another great example here. In 2020, we gapped out of this great shaper pattern. We pulled back almost immediately right to the 8 exponential. We found support, and that really led the major advance that occurred after that. Very good low risk entry. I'm going through these very quickly because I really want to bring home the point that it's a little frustrating because they may go through the 8 exponential sometimes, but the 8 exponential moving average is just that great short-term moving average to really buy after these gap ups. And we had Zscaler here, gap right up out of the shaper pattern, really went sideways after that gap up, tagged the 8 exponential moving average, and we moved higher from that point on.